Welcome back to the trading room, everyone. I'm Shane Vernier. This is FOMC Live, and we got a lot going on today, a lot to unpack. The Fed has spoken, and it's certainly one of the bigger statements that it's made in a long, long time. We'll just hit on the high points, then we'll get right into price action. I want to welcome everybody in the room. I'd like to welcome everybody around on YouTube. Calvin, good to see you. Conquer, Bacon Surprise, Headshot Sniper. Yeah, this is sort of a big announcement for today. Really a unanimous decision, 75 basis point rate hike. And you also have the quote of the day for me. And this is really what I was just browsing through. I posted it in the live chat here. But really the statement of the day for me, here's what the Fed said. They want to attain a stance of monetary policy that is sufficiently restrictive to inflation to return to 2% over the long term. So for me, I sit there and I say, okay, what is the big word here? Key phrases today, what we're going to be listening for Jerome Powell to say is going to be a few things like restrictive, accommodative versus restrictive. It looks to me like accommodative is out. So we're going to be looking at rate hikes, consistent rate hikes from here on in. It looks right through 2023. Also the word tapering. I'm looking at tapering, not like the Fed's going to taper its balance sheet, but we're going to talk about tapering those rate hikes off. Now, there is an opportunity for Powell to come out in his presser, which is T-minus 10 minutes or so, in his presser to come out and say, okay, we're aggressive right now, we're hawkish right now, but we want to taper those rate hikes over the medium to long term. So perhaps this 75 basis point rate hike may be what exactly the doctor ordered as far as getting pricing stability back intact. Also, we want to hear the term incremental. We're going to be looking for incremental. Remember that RBA, Reserve Bank of Australia, they came out earlier and said, hey, we're going to be incremental rate hikes of about 25 basis points over the long term. That was the way that they saw going forward. I'm not necessarily certain if I put a whole lot of stock in that. I think if inflation gets bad enough, you're going to have to do what you have to do to really restore pricing stability. But definitely going to be looking for the word incremental and also data dependent. That's our favorite. We had a meeting earlier today, the analyst team. We were talking about data dependent. It's always the way that central bankers give themselves an out. Well, we're going to do what we expect, what the data tells us to do. So what is the data telling them to do right now? You've got pretty good employment numbers. You've got a positive GDP metric. You've got a lot going on here. And those are all reasons why the Fed could stay the course and potentially raise rates aggressively going into the near intermediate term. Now, for me, I'm always focused on data. I absolutely love fundamentals. When we look at what's coming our way in the next week or so, you've got NFP Friday. That's going to be huge. That's going to give us an idea if these rate hikes, if this hawkish monetary policy and quantitative restriction is going to actually be hurting the U.S. economy. Remember yesterday we talked about that open letter that the senators, a few senators in the United States penned the Fed. They said, how many jobs are you willing to lace with these irresponsible rate hikes? So for me, this is a great political season. We've got great fodder, we've got great fundamentals, and we've got some trading levels that are pretty darn good. So let's get right into it, and then we'll run a quick sound check on our feed from the Fed, and we'll go from there. We got T-minus about 7 minutes until Jay Powell takes the stage. I got him up on another monitor, so we'll be clicking over there relatively soon. What I would like to say right here, dollar index. Now remember, this has been our long-term value area that we really have outlined, the area between 115 and 110. It's a very basic analytical approach to this, but it's been very effective. And right now, we're coming right off to that 110 level. So even though we went up 75 basis points today, and that was a very hawkish thing that they said they will attain a restrictive monetary policy to restore pricing stability and get inflation back towards that long-term 2% average target. To me, it doesn't get much more hawkish than that. Now, will Jay Powell walk those sentiments back when he takes the stage here in a few minutes? Very possible. But for me, this bearish action in the DXY, boy, I'd be sitting there right at 110, sort of licking my chops. I really would. I think that I'd be surprised if we leave this value area between 115 and 110. To me, that is where the DXY is going to be for quite some time. We ran a poll in the trading room here. Everybody that's just sort of watching us online, that's fantastic. But if you're in the trading room, we really wanted to outline what folks wanted to look at during this release. And we've got the Euro USD was the overwhelming winner. And then we had gold was it was a second place. And then we had the US 30 and Bitcoin came in a distant fourth. So thank you for everybody that participated in that. We're going to be looking at gold, the Euro USD, and the US 30 today while Jay Powell's speaking. What I like to do trading these things, put out a YouTube video not too long ago. It was about how do I trade NFP. I would approach this in much the same fashion. I've got my long-term anchor points down, and I'm going to be watching these on very short-term duration charts, very, very short I would say 1 minute charts is what we're going to be watching as Jay Powell speaks. What we have here is my Euro USD outlook. I love 102.83 to the top side. I think that parity is going to come into play right here, probably on Powell's statements. I'm just expecting that wild price action to sort of dictate policy. And as you can see, since our official statement came out from the Fed, we had really a nice, robust run up in price here. Boom, we go right up to about 99.60, and then we've sort of tapered off. So this is indicative of a Fed day. Remember, you get that release, and then about a half hour later, you get the big time market action on the Fed chief's statements. So right here, you're looking at a nice, beautiful run up, which sort of suggests it's a little bit dovish, and now we're tapering off. I'm looking for a correction. I'm looking for an immediate correction. But if we do get something crazy to happen here in the next 24 hours to 48 hours, I will be at that long-term anchor point, sort of with bells on. Let's take a quick look at my weekly chart. I look at my weeklies as sort of my bread and butter when I'm talking about most Forex pairs, and I like to trade these on the 4-hour chart. But if you take a look at your weekly, what do you have? A nice 3-week run up from that doji low, and you've got a nice spike high right there and a retracement right to 50%. So right now, we're very, very tight. We're very, very compressed. We're waiting for this market to blow off some steam to the downside. 98.08 doesn't look too bad for me. To the top side, though, that 102.83 is something that I would love to absolutely tag to the short here in November at some point. So that's what we're looking at there. As far as any trades coming across the boards today, I'll have all eyes on 98.08. 99.19 it's fairly key as well. We've just traded this area very, very aggressively here throughout the lead up, the 48-hour really tailgate or pregame for the Fed announcement. So pretty good stuff right here. We're going to go right back down to a 1 minute chart though, because we do want to see what price does in really right after pretty much on every statement Jay Powell makes. I want to see what price does. I'm not sure how you guys trade big releases like this, but that's how I like to do things. Right here, the gold was our second place winner. Now this is more along the lines of potentially giving us a trade. This is our long-term levels, our COVID 2020 panic lows, all the way to that double top, those all-time highs. Not all-time highs, but this year's highs right up after that Russian invasion of Ukraine, up there around 2075. So right here, there 62% was a fantastic support level. We traded it over and over and over again. And today we have that opportunity to where, hey, maybe support is now resistance. And you're looking at 1692, the top side. I can see that coming into play by the end of today. So that's a fantastic anchor point for me. Definitely want to be looking at that weekly. EMA is right there at 1691. So 1691, 1692 for me is going to be a big time level in gold. I'll be looking to potentially short there. We have some great gold traders in the room. I see you guys working in here. Fantastic. We've done well today. You'll notice your 1 minute is much the same as that Euro USD. You had really a robust run up here right after the release, and now we've just sort of been flatlining. We're waiting. We've established a new value area, short-term value area, and now we're waiting for Jay Powell to say something that we can use. So that's really how we're going to approach this. As far as the US 30 goes, really a fantastic level in play right now. This is a monthly US 30 chart. We're back above 38% of that 2020 low to 2021's highs. You're right there. You're above 38%. That tells me that long-term range is still fairly bullish. We have to respect the long-term technicals here as we move forward, even on short time frames. I'll show you how right now. Right here, 78% is your 3-month range. There's a big negative range. There's a big negative range. Epic breakout bull run here in October. You run right up to that 78%, which is at 33.067. And right here today, we're sort of closing on that area, 33.0118. I'm cautious. I'm not even risk off. I'm not even risk on. I'm just looking at the tote board. I'm saying, okay, we got a big bullish break here. I'm skeptical of this. I'm thinking reversal. If Jay Powell comes out and says they're going to be measured in their movements, look out. We could see a major bullish break here in the US 30. Key level for me is 33.06. And then right here, you can see our 1 minute action, gapped higher, flat, rotating north. So for the time being, we're just going to sort of cursor through a few of these on short time frames as Mr. Powell takes the stage. And this should give us a decent look at the action. If I can get my head out of the way potentially. There you go. Give you a little more room to work. Let's do a quick sound check on this. Make sure everybody can hear it. If you just want to weigh in the live chat for me, that would be absolutely fantastic. Just give me a quick thumbs up if you can hear it. That would be great. Should be ready to roll. Thanks, Vegas Surprise. I appreciate it. Kid 8, Timmy Tomato, right on. I'll do my best not to start shouting. Okay, here we go. Key event for the Fed. We have to keep a close eye on everything Jay Powell does. Very, very important. Everything from his necktie right on to his mannerisms. Last time he was a bit nervous. Jay was a bit nervous. We'll see what happens here. MJ, Shane looks so excited. It's like Christmas morning to me, MJ. Absolutely love it. We're going to get in here and start unpacking some serious fundamentals. Look at these 1 minute Euro traders just starting to bid just a little bit, trying to get the jump on the big man coming into the room. It's good stuff. Good to see you, Litchi. Welcome back. Mantis, what color is this tie? I'm going to be all over that. You can believe that one. Also, the Q&A, hugely important. We're looking for key questions out of Steve Leisman, also Greg Rabb. Those are the veteran reporters in that room. We're going to be looking for them to really set the tone. Okay, we have a gray tie. We have a gray neutral tie. Fantastic. What does that mean? Is it ominous? It's not red. It's not blue. It's not even purple. Election next Tuesday.
Good afternoon.
Light blue.
My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools that we need and the resolve it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%.
That's as hawkish as it gets.
We're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance of policy for some time.
Twice on the restrictive word.
I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Real GDP rose at a pace of 2.6% last quarter, but is unchanged so far this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates.
Lower real disposable income.
Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated.
See, I mean, that's a silver lining.
Robust, with employment rising by an average of 289,000 jobs per month over August and September. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers.
So the economy is still hot, that's what he's saying.
Has little changed since the beginning of the year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in September, total PCE prices rose 6.2%, excluding the volatile food and energy categories. Core PCE prices rose 5.1%. And the recent inflation data again have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has created additional upward pressure on inflation.
Say something about COVID.
Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will
become entrenched.
The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective.
How's that, Lord Bastion?
At today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
I mean, this is as hawkish as it gets.
Financial conditions have tightened significantly in response to our policy actions, and we are seeing the effects on demand in the most interest rate sensitive sectors of the economy, such as housing. It will take time for the full effects of monetary restraint to be realized, especially on inflation.
I mean, this is screaming
reversal. That's why we say in our statement that in determining
reversal.
The pace of future increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal.
It's all about forward guidance right now.
There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected.
Oh boy, oh boy.
Our decisions will depend on the totality of incoming data and their implications for the
we're data dependent,
but
we're channeling our inner Volcker right now.
We'll make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored.
Looking at 98.08 right there on the weekly, 62%.
Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices.
So we have to do this. We have to do this no matter what. No matter if we lose some jobs, we have to.
Against prematurely loosening policy. We will stay the course until the job is done.
We will stay the course. Vastly different than what the RBA said the other night.
We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission.
Hey, they're doing it for you.
We at the Fed will do everything we can to achieve our maximum price stability goals. Thank you, and I look forward to your questions.
I mean, we just wiped off 400 points off the Dow like that. I mean, this is fantastic action right here. Very surprised that we had the rally early on.
The need to slow the pace of rate increases at some point is a downshift contingent on a string of better inflation data specifically between now and, let's say, the December meeting? Or is that something that the Fed could potentially proceed with independent of that data, given the lagged effects that you mentioned?
So a couple things on that. We do need to see inflation coming down decisively, and good evidence of that would be a series of down monthly readings. Of course, that's what we'd all love to see, but I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the appropriately restrictive level.
What is the test?
We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation, taking into consideration lags, as I mentioned. We will be looking at real rates, for example, all across the yield curve and all other financial conditions, and as we make that assessment.
That's a fantastic way of saying next week's CPI number isn't going to drive our policy.
Hi,
that's exactly what he said.
With Reuters. Look, I'm sure there's going to be tons of confusion out there about whether this means you're going to slow in December or not. Would you say that the bias right now is not for another 75 basis point increase?
So what I want to do is put that question of pace in the context of our broader tightening program, if I may. And talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was, and has been, how fast to go. The second is, how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So on the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0.
Yeah, but nothing
It's
happened.
a historically fast pace, and that's certainly appropriate, given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is
32.8,
how
look
high
at
to raise our
32.8
policy rate,
now.
and we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time, and we put that into our post-meeting statement. Because that really does become the important question, we think now, is how far to go, and I'll talk more about that. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time.
Hugely hawkish.
Of course, with the
Higher than
lags between
expected.
policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects economic activity and inflation. So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that.
Wow.
No decision has been
Wow.
made. It is likely we'll have a discussion about this at the next meeting, a discussion.
There's your
To be
rally.
clear, let me say again, the question of when to moderate the pace of
wow.
increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restrictive, which really will be our principal focus.
So
If I
basically,
could follow up on that.
he did a 180.
To what
Started
degree
backing
was
off.
there an importance or weight given to
That's what
the
all
need
those
to signal
reports
this
yesterday were based
possibility now,
upon,
given
pivoting
all
off of the
concerns
aggressively
really around
hawkish
the globe
right now.
about Fed policy sort of
This chart
arriving
says it
ahead,
all. I mean, look at
everybody
this.
else,
You're back up to
dealing with
250
their
in
own
the Dow.
stress as a result.
It was crazy price action. Give me some, some gold here.
I'm pleased that we have moved as fast as we have. I don't think we've over-tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. So I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion.
Absolutely.
About what
Long
that
term,
might
you're going to be at
mean.
5% at some
And we did
juncture. The
discuss
question
this, and
is, do we
as
get
I
there in
mentioned, we'll discuss it
Q1?
again in
Q1
December.
2023, or do we get there
But there's
now?
I don't have any sense that we've over-tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember, though, that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
Committed to the policy, not backing off, though.
Nick Tamarosa, The Wall Street Journal.
How you doing,
Chair
Nick?
Powell, core PCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high 4s, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are
I
imparting
mean, that's a
enough
legitimate
restraint
question.
to
That's a
bring
legitimate
inflation
question.
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward, a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher.
Fairly
I think
uniform
financial
1-minute
conditions
action
have
there
tightened
in
quite a
Euro
bit.
USD.
So
I mean,
I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I could follow up, what is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. So there are many models that look at that.
He's not answering that one.
I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs,
pretty much Jenny Powell's answer every time is the same. It's banker speak.
Substantially above.
We
for
should write a
some
book
time.
on
We'll
it, do a
see
few
move up,
videos,
but the
banker
movement
speak.
will be fairly gradual.
For me, the key is
So
set
I think
restrictive
that's what,
multiple
the principal
times here.
models would tend to say, but I wouldn't want to land on any one assessment. There are many different, as you know, many different people publish an assessment of underlying inflation.
Thank you.
Hi, Chair Powell. Thank you for taking our questions. Gina Smilik, New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Good question.
Is inflation becoming entrenched?
Well, it's not transitory
I guess I
anymore,
would
Jay.
start by pointing to expectations. So if we saw longer-term expectations moving up, that would be very troubling. And they were moving up a little bit in the
Pretty much met
middle part of this
58
year, and they've moved
or
now
85.
back down. That's one piece of data. Shorter-term inflation expectations moved up between the last meeting and this meeting, and we don't think those are as indicative, but they may be important in the wage-setting process. There's a school of thought that believes that, so that's very concerning. I guess the other thing I would say is that the longer we have, we're now 18 months into this episode of high inflation, and we don't have a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so,
Well, that's not good.
the thing we need to do
You
from a
guys
risk
knew when it was
management standpoint is
transitory.
to use
Remember
our
that,
tools
Jay, about 9 months ago?
forcefully but thoughtfully, and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do, and what we're strongly committed to doing.
Sort of a tough love presser. Say, nah, rates are going up.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. The statement points to lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Come on, have a clear answer one time. Show her the formula.
The way I would think about that is, it's a commonly, for a long time, thought that monetary policy works with long and variable lags, and that it works first on financial conditions, and then on economic activity, and then perhaps later than that even on inflation. So that's been the thinking for a long time.
Man, crude
There was
oil's
old
holding
literature that
extremely
made
bullish.
those lags out to be fairly long. There's newer literature that says that they're shorter. And the truth is, we don't have a lot of data of inflation of this high in what is now the modern economy. One big difference now is that it used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before, in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy, because the markets are thinking, what is the central bank going to do? And there are plenty of economists that also think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess the thing I would say is it's highly uncertain. And so from a risk management standpoint, it would be irresponsible not to ignore them, but you want to consider them, but not take them literally. So I think it's a very difficult place to be, but I would tend to want to be in the middle, looking carefully at what's actually happening with the economy, and trying to make good decisions from a risk management standpoint, remembering, of course, that if we were to over-tighten, we could then use our tools strongly to support the economy. Whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the employment costs in particular.
Okay, so they're going to raise aggressively because they can easily correct that problem. Just cut rates,
we want to be
right?
sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
Pretty good fight here. The Euro USD right at 99.
The addition to the statement
Look at the
to mean that
98.08
more
to the
weight is
downside
put into
here,
those lag effects than they
potentially.
would have been after previous rate hikes?
So I think as we move now into
Dollar index making a comeback.
into restrictive territory, as we make these
Dead center
ongoing
of
rate
our
hikes and
range. Well,
policy
not yet,
becomes
but we
more
will be.
restrictive, it'll be appropriate now to be thinking more about lag. Of course, we think about the lags are just sort of a basic
Gold coming
part
off.
of monetary policy, but we will be thinking about them. But we won't be, I think we'll be considering
Monthly
them
double
because
bottom
it's
right around
appropriate to do so.
16.14.
Let me say this:
long-term support at
it is
15.87.
very premature to be thinking
Might
about
get it.
pausing.
Might
So
get it
people,
this
when they hear
week.
lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy, we need
Man, does
ongoing
he's
rate
Malcolm
hikes
in the
to
middle
get
himself.
to.
Yeah, he's
to that
negotiating a
level
tough period
sufficiently
of American
restrictive,
finance.
and we don't. Of course, we don't really know exactly where that is. We have a sense, and we'll write down in the December meeting, a new summary of economic projections.
A lot of
which
I don't
updates
knows
that.
today.
But I would expect us to continue to update it based on what we're seeing with incoming data.
Thanks,
Holy
Chair
cow.
Powell, Miller with Axios. As you look around the economy, the clearest impact of your tightening so far has been
32.1,
on housing, maybe some
potential
interest on the
support.
tech companies. It's been relatively narrow in terms of labor market, consumer demand. A lot of sectors you don't see a ton of effect. Is the pathway and channels through which monetary policy works
There's a
changing?
gap.
Is it narrower than it
Gap
used to
down.
be? And on housing in particular, are you at all worried
Look
that
out.
you're crimping housing supply in ways that might cause problems down the road?
I don't know that the channels through which policy works have changed that much. I would say a
32.1.
big channel is the labor market, and the labor market is just very, very strong, very strong. And households, of course, have strong balance sheets.
VIX
And
index
we
just
go
broke
into
over
this
26. Now we have the dollar index rallying to
a strong labor
111.50.
market and excess demand in the labor market.
Big time
as you can
shift
see
in
through
sentiment
many
in the
different
last
things.
minute.
And also with households who have strong spending power built up. So it may take
Crude
time.
oil
It
coming off
may
hard.
take resolve. It may take patience. It's likely to get inflation down. It may. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll
How
take
long?
time. We think. So, sorry, was I getting to your question there?
No.
Oh, housing, the housing part of it. Yeah. So, we look
you
at
see you
housing.
dodged that
Of
one.
course, housing is significantly affected by these higher rates, which are really back where they were before the global financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing housing activity decline. You're seeing housing prices growing at a faster rate, and in some parts of the country declining. I would say the housing market was very overheated for the couple of years after the
Yeah,
pandemic. As
exactly.
demand increased and rates were low.
M. Martin, this is all
And we all know
politics,
the stories
100%.
of how overheated the housing market was, prices going up, many bidders.
See, he's always trying to put
no
things in
conditions,
historical
that kind of thing.
context.
So the housing
the
market
blame
needs to
is
get
never
back
on
into
the
a
person at
balance
hand.
between
You
supply
always
and
look
demand.
back 15 years.
We're well aware of what's going on there.
I mean, this is a
From
crater
a
job
financial
here.
stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit
That's debatable.
was very carefully,
That's
much more
debatable,
carefully
Jay.
managed by the lenders.
Here we go,
So,
32
it's a very
ones.
different situation and doesn't appear to present financial stability issues. But
Dollar on the march all of a sudden.
no,
yeah, here we
do
go in the Euro
understand that
USD.
that's really where a very big
Where's
effect
that
of
98 level
policies
right
is.
there? Boom. 98.63. This could get ugly here.
Hi, Victoria Guida with Politico.
98.08.
I wanted to ask about the labor market. You mentioned early on again
That's a major
that
shift
job
right there,
openings are
major
very
shift.
high compared to available workers. And I'm just curious, to what extent you do and don't draw a signal from that. So, for example,
David J.,
if
boy, the
wage
media's
growth
all of a
is
sudden
slowing
hating this guy.
and
Boy,
if
they
maybe
are
the
hard on
unemployment
him,
rate
aren't they?
starts to tick up, will that make
haven't
you
seen
sort of
Leisman or Rapp
increase your
yet.
focus
Or Rob,
on
excuse
job
me.
openings? What do you see? Are wages what's really important? How are you thinking about the labor market as it relates to inflation?
So we talk a lot about vacancies and the vacancy to unemployed rate, but it's just one. It's just another data series. It's been unusually important in this cycle because it's been so out of line, but so has quits.
A combative
so have
press
wages.
coordinate.
So we look at it.
Where have they
very
been?
wide range.
Oh, yeah,
of
there's an
data
election next
on
week,
the
right? We need a bad guy.
on the labor market. So I'd start with unemployment, which is typically the single statistic you would look to, is at a 50-year low, 3.5%. We're getting really nothing in labor supply now. We had, I think, very small increase this year. which we thought we would get that back. Most analysts thought we would get some labor supply coming in. You mentioned wages, so I guess I would characterize that as sort of a mixed picture. It's true with average hourly earnings you see, so I would call it a flattening out at a level that's well above the level that would be consistent over time with 2% inflation, assuming a reasonable productivity. There with the ECI reading this week, again, a mixed picture. The headline
What's
number
reasonable
was
productivity?
a disappointment. Let's just say it was high. It didn't show a decline. There's some rays of light inside, that if you look at private sector workers, that did come down. The compensation did come down. But overall, though, the broader picture is of an overheated labor market where demand substantially exceeds supply. Job creation still exceeds, the sort of the level that would hold the market where it is. So that's the picture. Do we see? We keep looking for.
No, I mean these are
signs
some
that
non-answers.
sort of
He's even got me on my
gradual
hands. I don't know
softening
what to say
is
about these
happening.
answers.
Maybe that's there, but it's not. It's not obvious to me because wages aren't coming down; they're just moving sideways at an elevated level. Both
Well, if
ECI and
they're
average
moving
hourly
sideways
earnings.
at an elevated level.
We want to see. We would love to see vacancies coming down, quits coming down. They are coming down. Vacancies are below their
Quits.
all-time high, but
Use that
not
word
by
again,
as much
quits.
as we thought because the data series is volatile. We never take any one reading. We always look at 2 or 3. So it's a mixed picture. I don't see the case for real softening just yet, but we look at. I guess as I just showed you, we look at a very broad range of data on the labor market.
So do you see wages as being a significant driver of inflation?
I think wages have an effect on inflation, and inflation has an effect on wages. I think that's always been the case. There's always
Okay.
a going back and forth. The question is that
Holy
really
cow.
elevated right now? I don't think so. I don't think wages are the principal story of why prices are going up. I don't think that.
Yeah, blame Russia,
I also
Ukraine.
don't think that we see a
Get
wage
some
price
supply chain
spiral.
going. He hasn't
But
harped
again,
much on
it's
that.
not something you can, once you see it, you're in trouble. So we don't want to see it. We want wages to go up. We just want them to go up at a level that's sustainable and consistent with 2% inflation. And we do think that given the data that we have, that this labor market can soften without having to soften as much as history would indicate through the unemployment channel. It can soften through job openings.
Basically, MJ, guys, we got good
think
jobs.
there's
Calm down.
room for that.
That's
but,
exactly
we won't know
right.
That'll be.
Hey, everybody,
discovered
relax.
empirically.
Great jobs.
Thank you so much. Kayla Tausche from CNBC. Earlier last month, the United Nations warned that there could be a global recession if central banks didn't change course. The new UK Prime Minister warned of a profound economic crisis there. And I'm wondering how the Fed is weighing international developments in light of a very strong economy here in the U.S. that would seem to be bucking those trends.
So, of course, we keep close tabs on economic developments and also geopolitical developments that are relevant to the economy abroad. We're in very frequent contact with our foreign counterparts, both through the IMF meetings and the regular meetings.
They're
with
getting
central
ready to
banks
speak
that we
here in a
have,
few
and I have
hours,
one this
Jay.
weekend with many central bankers. So we're in touch with all of that. So I guess it's clearly a difficult time in the global economy. We're seeing
32.5.
we're seeing very high inflation in Europe, significantly because of high
Gonzo.
energy prices related to the war in Ukraine, and we're seeing China's having issues with the zero COVID policy and much slower growth than we're used to seeing. So we see those difficulties. The strong dollar is a challenge for some countries, but we have it, and we take all of that into account in our models. We think about the spillovers and that sort of thing. Here in the United States, we have a strong economy, and we have an economy where inflation is running at 5%. Core PCE inflation, which is a really good indicator of what's going on for us, is the way we see it, is running at 5.1% on a 12-month basis, and sort of similar to that on a 3, 6, and 9-month basis. So we know that we need to use our tools to get inflation under control. The world's not going to be better off if we fail to do that. That's a task we need to do.
Quinn, strong dollar is a challenge for some countries.
In the United States is a good thing for the global economy over a long period of time. Price stability is the kind of thing that pays dividends for our economy
it's the
for
gift
decades.
That keeps on giving.
Even though it may be difficult to get it back, getting it back is something that provides value to the people we serve for the long run.
If I could just follow up on that. Thank you. The Fed has acknowledged in the past that the tools that you have don't affect things like energy and food prices that stem from some of those conflicts overseas, and they're some of the biggest pain points for consumers. So as you pursue the current path that you've outlined, is there a risk that some of those prices simply don't come down?
So we don't directly affect, for the most part, food and energy prices, but the demand channel does affect them just at the margin. The thing about the United States is that we also have strong, in many other jurisdictions, the principal problem really is energy. In the United States, we also have a demand issue. We've got an imbalance between demand and supply, which you see in many parts of the economy. So our tools are well suited to work on that problem, and that's what we're doing. You're right, though. We don't, the price of oil is set globally, and it's not something we can affect. I think by the actions that we take, though, we help keep longer-term inflation expectations anchored, and keep the public believing in 2% inflation by the things that we do, even in times when energy is part of the story of why inflation is high.
Part of the story. Natural gas is up 6.25% today.
Hi, Chair Powell. Janelle Marte with Bloomberg. So the Fed is facing two more ethics-related incidents with the revision of the financial statements from President Bostic and President Bullard speaking at a closed event. So some senators like Elizabeth Warren are saying that this is a sign of greater ethics problems at the Fed. Could you talk about what this does to the public's trust in the bank and what the Fed is doing to
it's
prevent
gloves
this kind of
off time
behavior
against
from
the Fed. They are the bad guys now.
Common.
Sure. So you're right. The public's trust is really the Fed's and any central bank's most important asset. And anytime one of us, one of the policymakers, violates or falls short of those rules, we do risk undermining that trust, and we take that very seriously.
Falls short of the rules. They break the rules.
So at the beginning of our meeting yesterday, actually, we had a committee discussion of the full committee on the importance of holding ourselves individually and collectively accountable for knowing and following the high standard that's set out in our existing rules with respect to both personal investment activities and external communications. We've taken a number of steps, and I would just say we do understand how important those issues are. I would say that our new investment program that we have is up now and running, and actually it was through that the problems with President Bostic's disclosures were discovered when he filed his new disclosures. We now have a central group here at the Board of Governors that looks into disclosures and follows them and approves people's disclosures, and also all of their trades. Any trade anyone has to make who's covered has to be pre-approved. And there's a lag. It has to be pre-approved 45 days before it happens, so there's no ability to game market. So it's a really good system. It worked here. And I think we all said to each other yesterday morning, we recommitted to each other and to this institution to hold ourselves to the highest standards and avoid these problems.
Yeah, Mike Benny, the media is combative today.
That are pending?
I don't. So, as you know, I referred the matter concerning President Bostic to the Inspector General. And once that happens, I don't.
No, we don't have anything to do with it. Once I refer that case upwards, I'm done. I'm out.
General I have nothing to do with that. Investigations. We don't really have that.
We certainly didn't talk about that trade. Good Lord. We're going to be looking at Jay Powell's tax returns here by the end of this presser.
Bloomberg Television and Radio. Earlier this year, you touted the 3-month bill yield out to 18 months as the yield curve.
Bullish crude oil today, really withstanding this hawkish storm.
And you said, quote, if it's inverted, that means the Fed's going to cut, which means the economy is weak. that curve is
Very
only
tight.
2 basis points
I mean, this is
away
the tough
from
whipsaw
inversion
stuff.
now.
Hope you
So
guys are on
I'm
the right
wondering
side of
why
these
you are
moves.
so confident that you have not over-tightened, particularly given that rates work with a lag.
Well,
111.50-ish on the DXY.
Forward
This has been a
spread, you're
pretty good
right.
recovery from
And
the early bearish
that's been our
stuff.
preferred measure. We think it, just empirically, it dominates the ones that people tend to look at, which is 2s, 10s, and things like that. So it's not inverted. And also, you have to look at why things, why the rate curve is doing what it's doing. It can be doing that because it expects cuts or because it expects inflation to come down. In this case, if you're in a situation where the markets are pricing in significant declines in inflation, that's going to affect the forward curve. So yes, we monitor it. You're right, and that's what I would say.
If I could follow up. You also said
He's just
several
trying to
meetings
get
ago
out of
that
there
the
right
risk
now.
of doing too little outweighed the risk of
Just
doing
doesn't
too
wanna
much.
play anymore.
Is what you're
I
trying
don't
to
blame
tell
him.
us today is that risk assessment has changed a little bit?
The Dow's just about back to even. I mean, this is whipsaw stuff.
Well, what's happened is time has passed, and we've raised interest rates by 375 basis points.
Yeah.
I would not change a word in that statement, though. I think until we get inflation down, you'll be hearing that from me. Again, if we over-tighten,
There you go, MJ.
and we don't want to, we want
just
to
trying
get
to
this
help.
exactly right. But if we
So
over-tighten,
it's goodwill that way.
then we have the ability with our tools, which are powerful, to, as we showed at the beginning of the pandemic episode, we can support economic activity strongly if that happens, if that's necessary. On the other hand, if you make the mistake in the other direction and you let this drag on, then it's a year or two down the road and you're realizing inflation behaving the way it can, you're realizing that you didn't actually get it, you have to go back in. By then, the risk really is that it has become entrenched in people's thinking.
China A50's all over
the record
the
is
map.
that the employment costs, the cost to the
Starting
people
to stabilize
that we
at
don't want to hurt,
11.7.
they go up with the passage of time. That's really how I look at it. So that isn't going to change. What has changed, though, you're right, is we're farther along now, and I think as we're farther along, we're now focused on that. What's the place? What's the level we need to get to rates? And I don't know what we'll do when we get there. By the way, it doesn't. We'll have to see. There's been no decision or discussion around exactly what steps we would take at that point. But the first thing is to find your way there.
Thanks, Chris. Thank you. Chris Rugaber at Associated Press. Just to go back to housing for a minute, you mentioned the impact that rate increases have had on housing. Home sales are down 25% in the past year and so forth, but none of this
Prices
is
are
really
holding
showing
firm,
up,
though.
as you know, in the government's inflation measures. And as we go forward, private real-time data is clearly showing these hits to housing. Are you going to need to
Yeah,
put
Tim, I
greater
went
weight
short of a
on
good
that
level,
in
but got
order to,
whipsawed out.
ascertain things like
That's
whether
how I
there's
would define
over-tightening
today,
going
whipsaw.
or will you still focus
May change
as much
tomorrow.
on the
Today's
more lagging
whipsaw.
government indicators?
So this is an interesting subject. So I start by saying, I guess, that the measure that's in the CPI and the PCE, it captures rents for all tenants, not just new leases. And that makes sense, actually, because for that reason, that conceptually, that's sort of the right target
Not
for
particularly
monetary
because
policy.
you have rent controls in a lot of metropolitan areas.
And the same
so
thing
those,
is true
those
for
numbers can
owners
be
equivalent
inherently
rent,
skewed,
which comes
Jay.
off of,
You know that. Come on. Come on, bud.
It's a reweighting of tenant rents. The private measures.
It's like we're
are,
charging
of
at this
course,
little
good
Dow
at picking
30
up
gap, the US 30 gap on the 1 minute.
At the margin, the new leases. And, they tell you a couple things. One thing is, I think right now, if you look at the pattern of that series of the new leases, it's very pro-cyclical. So rents went up much more than the CPI and PCE rents did, and now they're coming down faster. So the implication is that there are still, as people as non-new leases roll over and become and expire, right?
1650
There's
back
still
in play.
in the pipeline. There's still some significant rate increases coming. Okay, but at some point, once you get through that, the new leases are going to tell you that what they're telling you is there will come a point at which rent inflation will start to come down. But that point is well out from where we are now. So we're well aware of that, of course, and we look at it. And but I would say that in terms of what the right way to think about inflation really is to look
Can't complain with 200 pips.
at
Just
the
rack
measure that
200
we do
pips.
look at,
Right on.
but considering that we also know that at some point you'll see rents coming down.
At some point.
Quick follow. It looks like stock and bond markets are reacting positively to your announcement so far. Is that something
Positively.
you wanted to see? Is that a problem or
See, they've all got their computers. They're trading right now. They're on their MT4 platforms.
Positive reaction.
You know, we're not targeting any one or two particular things. You know, our message should be, what I'm trying to do is make sure that our message is clear, which is that we think we have a ways to go. We have some ground to cover with interest rates before we get to that level of interest rates that we think is sufficiently restrictive. And putting that in the statement and identifying that as a goal is an important step. And that's meant to put that question really as the important one now going forward. I've also said that we think that the level of rates that we estimated in September, the incoming data suggests that that's actually going to be higher, and that's been the pattern. I mean, I would have little confidence that the forecast
rates are going up higher than we thought last month.
If we were doing an S&P today, you know, the pattern has been that one after another
they go up, and you know, that'll end when it ends.
But there's no sense that you know, that inflation is coming down. It just
I mean that's the bottom line in this energy. This U.S. oil chart I have pulled up is telling you why we're on the doorstep at 90.
We're exactly where
and you just said you're raising rates for the foreseeable future.
Okay, so I would also say
natural gas trending higher.
To discuss pausing, and it's not something that we're thinking about. That's really not a conversation to be had now. We have a ways to go. And the last thing I'll say is that I would want people to understand our commitment to getting this done, and to not making the mistake of not doing enough, or the mistake of withdrawing our strong policy and doing that too soon. So I control those messages, and that's my job.
Edward Lawrence with Fox Business. Thank you, Fed Chairman. So how big of a headwind is all the fiscal spending to what the Federal Reserve is trying to do to get inflation back to the 2% target?
You know, in theory, it was a headwind this year, but I do think the broader context is that you have households that have these significant amounts of savings and can keep spending. So I think those two things do tend to sort of counterbalance each other out. It appears consumer spending is still positive. It's at pretty modest growth levels. It's not shrinking, people are, the banks that deal with retail customers and many retailers will tell you that the consumers are still buying, and they're still they're fine. So I don't know how big the fiscal headwinds are, and they haven't shown up in the way that we thought they would in restraining spending. So it must have to do with the savings that people have.
What about the
it
spending?
must have
There's
to
tens
do
of
with
billions
it.
yet to be spent. I mean,
I don't know
Inflation Reduction
today,
Act, the
Jay.
American Rescue Plan, CHIPS Act, Bipartisan Infrastructure Bill. How does that go and play into your thinking about the future?
You know, it's demand is going to have some support from those savings, and also from the strong demand that's still in the labor market. We still see pretty significant demand and a tightening labor market in some respects, although I think overall I would say it's not really tightening or loosening. So we see those things, and what those things tell us is that, you know, our job is going to require some resolve and some patience over time. We're going to have to stick with this. You know, that's just we take all that as a given, but we know what our objective is, and we know what our tools can do, and that's how we think about it.
Hi, Chair Powell. Nancy Marshall-Genzer from Marketplace. I'm wondering, has the window for a soft landing narrowed? Do you still think it's possible?
Has it narrowed? Yes. Is it still possible? Yes.
Wow.
I think we've always said it was going to be difficult, but I think to the extent rates have to go higher and stay higher for longer, it becomes harder to see the path. It's narrowed. I would say the path is narrowed over the course of the last year, really. Hard to say. You know, again, I would say that the sort of array of data in the labor market is highly unusual, and to many economists, there is a path to. Ordinarily, there's a relationship to GDP going down and vacancies declining. translating into unemployment, or there's Okun's law. So all those things are relationships that are in the data, and they're very real. Data's a little bit different this time, though, because you have this tremendously high level of vacancies, and we think on a very steep part of the beverage curve. All I would say is that the job losses may turn out to be less than would be indicated by those traditional measures because job openings are so elevated and because
just further justification. Here's justifying what
that's
they're
going
going
to be
to
something
do.
we discovered.
This is very, very hawkish, everybody. I really want to stress that.
No one knows whether there's going to be a recession or not, and if so, how bad that recession would be. And our job is to restore price stability so that we can have a strong labor market that
just keeps reinforcing that. This has been a tough presser, Jay.
Why do you feel like the window has narrowed?
Because we haven't seen inflation coming down. The implication of inflation not coming down, and what we would expect by now to have seen is that as the supply side problems had resolved themselves, we would have expected goods inflation to come down by now, long since by now. And it really hasn't, although it has come down, but it's not to the extent we had hoped. At the same time, now you see services inflation, core services inflation moving up, and I just think that the inflation picture has become more and more challenging over the course of this year, without question. That means that we have to have policy be more restrictive, and that narrows the path to a soft landing, I would say. Thanks very much.
Restrictive, restrictive, restrictive. That's the word of the day. Well, there you have it. Big picture, what did we learn? We learned that rates are going to keep going up. We learned that they're nowhere near where they need to be, anywhere near 2%. Also, you can see that the markets really took this one, I would say took it right on the chin. This was whipsaw action really the entire day. We sort of called this rally here in the DXY. I didn't see how we were trading this low to begin with. You can see the dollar really is on the warpath here over the last 30 minutes or so. What I would say is some of our macro levels are more than likely going to come into play in the coming 18 hours. We're going to be back a little bit later today to sort of unpack a lot of what happened across our favorite Forex pairs and things. We're also going to talk commodities. This is the one thing that really alarms me, and in my view, is one of your primary reasons behind what we've seen inflation-wise, and it's energies. And the bottom line is this: we're printing about $90 crude, $89.66 crude, and we're also bidding December. We're bidding December futures. That's wintertime seasonality. We should be seeing some bearish price action. And really, since the pullback that began in June, we've had back-to-back positive months here. So for me, I'm looking at this and I'm saying, okay, where can I possibly make a trade? And I'm pretty much going right around to the long side of the market. I'm not necessarily sure that we're going into that traditional winter seasonality. So, realistically, pullback buys, I'd probably go to my weekly chart, but pullback buys look pretty good to me. We saw big time draws on crude oil supplies here in the United States. That's really another bullish market driver, in my view. Big picture, what really did alarm me a bit during Powell's statement, and it was overtly hawkish. There's no two ways to say that. It just was. Rates are going up. We don't have a timeline. We're nowhere near 2%, but we've got to get there. We're committed to getting there. And when you start hearing things like that, you look at a commodity like a crude oil should be getting destroyed, and it's not getting destroyed. You've got gold that's sort of down 0.25%, real tight rotation. But when I'm looking at crude, that should have sent crude to $85. It really should have, and it didn't. So for me, I'm growing inherently bullish here on WTI crude. I think it pretty much pullbacks are going to put you in a good position to win this week, maybe an 87 buy. Not necessarily a bad area for me. This rotation that we've seen in gold, really the key level we highlighted this week is really our monthly double bottom. Back on the train, trading this November trade. If we do see that price extension, we could definitely be looking to step up and buy something like a 1587. I think that's a very important level. I would keep a close eye on that. 2020's low to 2022's high, 78% retracement of that. You definitely want to keep an eye on that zone there. Really your double bottom right around 16.14 to 17. You also want to keep an eye on that. That's a potential area where you may get a bearish break. But until we violate that zone and really take out that 1610-ish area, 1615-ish, until we violate that, we sort of have to be thinking we're in compression for the gold markets. Now, on a short time frames, we saw the crazy volatility. The biggest thing I want to stress moving forward is Give the market some time to digest this information. I don't know that I would be jumping headlong into something right now with a position trade type of a mentality, with a swing trade. Remember, BOE is out a little bit later, actually coming up, and geez, what I'd say it seems like a few hours, anywhere between Tuesday to Thursday to me, but definitely during that London session, you're going to get the BOE getting involved, and you can bet they're going to look at what the Fed did today, then they're going to start thinking about what they're going to do down the road. Bank of Canada. We had a real big sort of a news thing last week, a dust up with the U.S., and the Bank of Canada came out and said, listen, this dollar, this stronger dollar is just crushing us inflation-wise for a lot of foreign countries. They put that in their statements, and I think that you're going to definitely see more of that tone sink in as we get deeper into this year, and it starts tomorrow with the BOE. So if I'm looking at maybe something like the pound dollar, you definitely want to be conservative here as we really roll forward. It looks to me like we're really dead in the center of our our consolidation zone that we outlined the other evening. You had a situation right here, right around 115.60, which has been a key level for us. Didn't treat us very well, but helped us. We had some buy scalps that came in that 113.33 area, and we are in that phone booth. So if I'm trading this pair, I'm looking at 113.33 to the downside. I think that's pretty good. One last one before we sign off here. We'll take a look at the yen. Biggest thing that I wanted to really stress, we didn't get that monthly pullback that we were hoping we would get. That monthly chart right there, this run-up that has been 2022 for the yen, really a robust run-up, and we're sitting right down there with great support at 143.78. We're just nowhere near it. So if I'm looking at the yen for the rest of the week, the dollar yen, you definitely want to be looking at 150 to the top side and perhaps 143 to the bottom side, 143.75. If I'm more aggressive than that, you can go right to a daily chart and you can say, okay, what's happened here? And you see right there, boom, deep retracement and a bounce. There's no way to sugarcoat this trading day. It's been exceedingly choppy. That's how I would describe this. This has been whipsaw action. And as I look across risk assets, it looks like money's flowing out of risk. To me, it all started this morning with that MBA mortgage rate report where we came in just a bit below where we were last week. That's the first pullback in the 30-year fixed rate mortgages that we've seen in a very long time. So to me, I thought there might be some crazy whipsaw stuff. That was by far the most difficult presser that I've seen. There really wasn't much to hang your hat on other than we're raising rates for 75 basis points. We're going to stay the course. We're eventually going to get there. Until then, we're gonna wait and see what the data tells us, data dependent. So that's really where we're at. We'll be back here in a few hours. We're going to talk about gold and oil a little bit more. Fascinated by the oil dynamic right now, and we'll also point out some of those commodity dollars. We'll get into the dollar CAD. We'll get into the Aussie and things like that, and really look at some key levels in the trading room here. So good to see everybody. Definitely, we'll sort of leave you with this, the DXY. That's absolutely right, Arijit. DXY is rallying right towards 112. We were absolutely spot on with that call. We were trading down towards the lower quartile, I would say, or really the lower 10% of our range between 115 and 110. And look where we're going, right back to 112.50. So the more things change, the more they stay the same. All right, everybody, I want to thank you for joining me today. It's been always a great time tuning in. We got a few things to run through right here. New members workshop, I got one planned scheduled for tomorrow. Tune in. I'll be sure to introduce myself, show you exactly what we do here in the trading room, what the service suite is. Regular prop workshop, I did one earlier this morning. Be sure to check it out on our past streams. You can get in there and see really what encompasses our Academy to Fund a Trader program here at ForexSignals and how to trade. New Academy live in the trading room. Got psychology, strategy. Those are pretty good. Maybe if you took one on the chin today, keep a close eye on that psychology module. Maybe a great place to start there. And Academy to Fund a Trader program. We had some new features coming out that we covered in the prop earlier today. No more stop loss parameter, no more maximum leverage on one market, and also one-on-one coaching for funded traders. So we're excited. We have several of you that have crossed the threshold and that are now funded, and we also have a pipeline of talented folks that are getting ready to make get into what it is to be a professional prop trader. So we're looking forward to that. The idea here is to take you from Academy to Fund a Trader program, and even after you're funded, the development doesn't stop with one-on-one coaching. I've said enough. Jay Powell said enough. I'm going to sign off for right now. Be back in a few hours here with the Asia Pacific preview. I want to say thank you for everybody watching on YouTube. Thanks for joining us. If you want to tune in later, be sure to swing by the trading room. And check out a live stream or two. Kick the tire, see what you think with a 7-day free trial. All right, everybody, I'm going to kick off for now. You guys trade the action well, and we'll talk soon. See you.